Hello and welcome to this month's edition of Markets Unwrapped with me, Craig Melling, Director of Investment, and I'm joined by Nick Astley, one of the investment managers here at Progeny Asset Management. The first quarter of 2026 has been dominated by the escalating conflicts between the US and Iran, and it's had grave knock-on effects across all asset classes, equities, fixed interest, and even safe haven assets such as gold. The main reason has been the closure of the Strait of Hormuz and the impact that has had on energy prices. We've seen a rapid increase in energy prices leading to the price of oil up at $116 a barrel. Nick, let's just talk about where we are today. The market seems to be reacting from headline to headline, which makes it really difficult for investors. But where are we today? What is the state of play here on the 2nd of April?
Yeah, so it's a very fluid situation, Craig. A lot is changing on a daily basis, and that's being driven by the rhetoric coming out of the US and then the corresponding rhetoric from the Iranians. So the market's reacting accordingly. It doesn't know which direction to go in, and it's effectively just trying to gather all news flow and price itself.
So on the last edition of Markets Unwrapped, we really kind of focused in at the start of this conflict, but we were talking about how the markets were pricing in the conflict lasting 4 weeks or so, and impact that might have. Obviously, we're in week 4 now. Are we close to the end? Do we believe we're closer to the end now? And what do we know from Donald Trump?
So there appears to be a push from both sides to try and gain a resolution, to try and reopen the straits. So you've got the Americans at one side pushing for the deal they want, and the Iranians at the other side pushing for the deal they want. And the reality is they'll probably meet somewhere in the middle, and depending on how long that takes, will decide when the kind of market starts to normalize.
And we've heard various deadlines from the Trump administration. I think overnight we heard Donald Trump saying the escalation, the conflict could end in the next 2 weeks. So the market is really looking at this period over Easter and beyond to see some kind of resolution. I think for us, what's been really interesting is the volatility it's caused, hasn't it? And it's been widespread, almost indiscriminate, with the exception of potentially some oil and gas companies which are benefiting from the rapid increase in oil. It's very emotive. And I think, the last month in particular has been very emotional. We've seen lots of column inches, lots of headlines around what's been going on. And I suppose as a member of the private wealth team and managing high net worth clients day to day, I thought it'd be really interesting to talk about some of the questions you've been getting from clients and how are they feeling about the portfolios, the situation we're in, and what is it they're asking you?
Yeah, so we've had a lot of conversations with clients over the last month, and it's just been about reminding them that, markets do go down. This is quite normal. What's been atypical has been the situation we've been in for the last 12 months, where if we cast our minds back to the start of April last year, we were kind of getting a resolution to the Trump tariffs. So markets had, had a steady rise since that time, a little bit of a wobble between October and November time, but still ultimately our portfolios were up. That's atypical. We don't expect near enough a year of upward gains. We expect kind of ups and downs along the way. So it's just been about reminding clients that, look, markets do go up, markets do go down. It's about not reacting, not being emotive, but looking at the fundamentals of companies and the economics of the situation.
And I suppose, what kind of questions have you been asked? Our clients asking whether they should sell, our clients asking whether they should buy. It really is difficult for clients sometimes when they're seeing what's on the news. We know we're building portfolios for those long-term financial plans. And sometimes you have to not trivialize what's going on right now, but you have to look through the noise to some extent.
Yeah, so clients have been asking, does this fundamentally change anything to their financial plan if they're coming up to retirement? Should they fully encash their portfolios? But it's about taking a step back and looking at the bigger picture, looking at the longer term picture of what's the ultimate aim of portfolios and kind of adjusting accordingly, because market downturns provide great opportunities to invest in either new funds, new companies. There's securities that you maybe on your watch list that the downturns provided the opportunity to get into portfolios. So it's ultimately for clients who've been asking the questions of what should they do. It's about ensuring that everything that is done is consistent with the longer term planning.
It's really interesting. And I think let's just kind of pull back and look at what actually has happened in markets, not just in March, but actually where we are for the first quarter, because it's really been a tale of two halves, hasn't it? We came into this year quite optimistic. Our themes as a company were diversified or diversifiers. We were worried about geopolitical shocks. Obviously, we didn't forecast what has happened, but we knew there was a tendency that something like this could happen. We were thinking about the broadening out, but we were positioned for positive global growth. And I think over the last month or so, that rhetoric might have been challenged. We've seen a lot from central banks, and the expectation from interest rates have been very volatile. I think at the beginning of March, the Bank of England, for example, were focusing on 2 rate cuts this year. At one point in March, we heard there may be 2 or 3, 4 increases. I think we're kind of back to being flat now. But kind of where does this leave us? What have markets done in March, and what have they done for the broader quarter?
Yeah, so through March, we've seen a range of conditions, and on any given day, there's been a different rhetoric, and it's driven different financial conditions. What we saw at the start of the month when the conflict kicked off is we saw a bit of a panic selling across the board. So investors, kind of looking at the global community, were selling things that had done well for them. So we saw things such as gold, which would normally be a safe haven asset that investors would flock to. We saw investors selling gold, and gold was down double digits for the month. And that was because instead of it being a safe haven asset, people were saying, what have I done well on the last year?
Liquid
Assets, and let me sell those. So we saw that with headline equities. And the start of March, we saw a sell-off in fixed interest as well, because 2022 is still in fixed interest investors' minds. And what happened then was we saw a conflict, we saw oil prices spike, and we saw that for a sustained period. So immediately investors were thinking, is this, what's the duration of this going to be long? And is there going to be inflation back in the system? So let me sell some of my fixed interest holdings. So, initially early in the month, we saw some indiscriminate selling across the board. And then we started to see some positives. So we started to see a bit of an upturn following that selling. And then, since then, it's effectively just been driven by any given day. What's news flow coming out of the US and coming out of Iran. And, the oil price has been very volatile. That's helped certain regions like the UK that's got, a couple of big oil majors, which form a decent part of the index. And then, the knock-on effect, though, is also thinking about financial companies and where are the risks to all of this. So we saw for UK investors, the US stock market was down about 3%. And what helped UK investors is there was a strengthening of the dollar. So for a US investor, the stock market was down about 5%, but the UK investors benefited from that strengthening of the dollar. So that helped offset some of the losses. So the US was one of the best performing major indices for the month. So other regions such as the UK had a tougher time. So the UK was down circa 6% for the month. Regions such as Japan, that's had an incredible journey so far this quarter, had a tough month as well in March, where they were down double digits as well.
And these are heavy energy reliant countries, are they? Europe, we know, has had a tough time because they're an oil importer. And I think one of the biggest impacts, and one of the markets we've talked about in previous editions, for just how well it's done his career, that's been the hardest hit market, falling circa 20% this month, hasn't it? But I think, a month is still very short term. For the quarter, we've got a different story. And I know if we look back a year, we've seen strong market returns. And as you say, markets do embrace pockets of volatility like this. But shall we just remind watchers and viewers just what we've done for the quarter today, and then we can think about where markets are going for the rest of 26?
Yeah, so what we've seen so far for the quarter is actual positive returns for the likes of the UK, for Japan. There's been a slight downturn in the US, down circa 2.5% for the quarter. However, it's about remembering that March is 1 month in isolation, and actually investors' portfolios are roughly where they were at the start of the year, and that was following a strong 25.
That's really interesting, isn't it? Because we've talking about how emotive this event is. And I mean, actually, when we take that little step back, we need to remember that January, February were very good months for equity markets. But, coming back to the themes we had at the beginning of the year, I think we still believe there's going to be a broadening out of returns. I think once we see an end to the conflict, and we hope we see that extremely soon for a number of reasons, but we think that broadening out of returns will continue. I think the one question mark we have to our kind of base case for coming into 2026 was economic growth and that stability, albeit not spectacular, but modest economic growth. And I think as a team, as a wider committee here at Progeny Asset Management, we're now talking about inflation more than we've ever spoken about it, aren't we? There's the oil price, there's the heating prices, there's fuel prices, agricultural, fertilizer, lots of impacts from what's happened this month, which could have a knock-on effect the longer this conflict goes on. So I think for us, looking at interest rates and inflation is probably going to be our big focus for the rest of 2026, isn't it?
Yeah, no, absolutely seems to be the case, and especially that will be driven by the duration of this conflict, how long it lasts, and how long oil stays elevated.
Yeah. So I mean, whilst there's uncertainty, we don't know how long the conflict's going to last. We don't know the impacts. Feels very much like the tariff situation of April last year. We don't know the impact of what's happening. All we can do for portfolios is continue to position them sensibly. The theme I've been talking about and we've been talking about to clients is diversify the diversifiers across the portfolios we run. We've got equities, we've got bonds, we've got alternatives. They are positioned to be cautious right now, and that's a stance we've had for much of the last 6 to 12 months. So, speaking to our end clients, speaking to investors looking today, worried about the conflicts, I think, the real message is we're looking through it right now. We are monitoring certain situations, but, as long as portfolios are well diversified, constructed to help deliver the financial plan, I don't think clients should be too worried or certainly not panicked right now. We're working very hard on their behalf, aren't we? And we're thinking about that short, medium and longer term. Thank you for joining us on this month's Market Unwrapped. But if you do have any questions whatsoever, please reach out to your advisor or your investment manager. We're more than happy to discuss what's been going on and how the portfolios and the plans are performing. But as always, stay safe and join us on the next session.